we start the next keynote presentation. And I am going to start that one right on time at 1 o'clock. It's Torsten Slok. He's the Chief International Economist for Deutsche Bank. He's going to be doing a presentation on global economic outlook. Torsten's brilliant. You may have seen him on CNBC, on Bloomberg News. Torsten, are you on with us right now?
I am right here indeed.
Okay, I'm going to stop sharing my screen to allow you to project your presentation, okay?
Okay, I will do that. So let me see here, share screen. Okay, so thanks very much, Mike, for having me. I really appreciate it. And thanks very much to everyone for listening in. The plan here was to talk for the next 20, 25 minutes about the economic outlook and what's been going on in markets and where things are going from here. And the way we think about this situation falls into three different categories. And these are the categories that I have here in the headline, namely, first of all, what is going on with the virus, what's going on in markets. And once you have an answer to those two questions, then you will also have an answer to what is the shape of the recovery. Our conclusion is, in the charts that I'll be showing you in a second, that yes, it's true, as we just debated in the previous session, that there are some signs of the virus coming back. But if you look at it more from a more nuanced perspective of not only at the number of new cases, but also look at the hospitalization rates and also the number of people dying from COVID-19, you do get a more mixed picture in terms of this idea that we are about to see a significant drop in the number of new cases. It's true that the number of new cases has gone up, in particular in Texas, in Florida, and Arizona. But if you look at it more broadly, and in particular if you look at it more globally, it is certainly the case that the virus curve is flattening out, and therefore there is, in our view, less reason to be worried. That, of course, doesn't mean that we should not be spending time on what's going on in those pockets in the US where you're seeing the virus begin to move, and the number of new cases begin to move higher. We try to look at it at a county level, and we calculated that if you look at the number of new cases going up, that is happening in areas that account for roughly 30 to 50% of US GDP. So in that sense, it is an important point that yes, from a GDP and a macroeconomic perspective, it does matter. But broadly speaking, the virus curve is, in particular globally, but even also still in our view, when we look ahead, flattening and will be looking better going forward. Also, as our equity analysts keep on reminding me that hospitals are much more prepared today than they were in March, much better in terms of the processes, how to deal with the problems, how to deal with some of the side effects and side diseases, and how these things are generally being treated, and of course also much better at dealing with PPE problems. So we, generally speaking, are relatively optimistic on the virus not being a problem for a long time, and we still see the virus curve flattening out, and I'll show you one picture with that in a moment. On markets, of course, the Federal Reserve has been extremely aggressive. That has been, of course, very, very helpful in stabilizing financial markets. But I'll just show you a few pictures, what markets, of course, have been doing. We all know this too well, but it's important to remind ourselves the finer details of what actually happened and how far we have come in returning to what could be described more broadly as normal. And the third and final point on the slow recovery, I'll be just showing you a few pictures why we expect, despite our optimism on the virus and despite our optimism on markets, we still expect this recovery to be relatively weak, mainly because there are some behavioral changes on the part of consumers and corporates, but also because the unemployment rate is still very high, which also speaks for a relatively slow speed of the recovery overall. So this is the outline and the agenda for the charts that I brought along today. First, talk about the virus curve, then talk about financial markets, and finally talk about what is the shape of the recovery. We see it not as a V shape, not as an L shape. People sent me pictures of a bathtub-shaped recovery, and we don't see definitely an L-shaped recovery. We see it more as a Nike swoosh or the checkmark-shaped recovery, where you should expect to see some gradual rebound over the coming quarters, but where it is going to take quite some time to crawl out of this hole. Finally, I'll talk about the investment implications for what does it mean for rates, for FX, credit, and equities. And of course, also I'll be debating and talking about what does it mean for alternative assets, which of course, as I know, for all of you are much more expert in than I am. So let's first just look at a quick chart with what's going on, virus, and why do I say that the virus is looking better, in particular globally. The blue line in this chart here shows you the number of countries with higher than 5% growth rate and the daily number of confirmed cases. So as you can see, the blue line peaked in late March, and the beginning of April, it came down relatively quickly. You saw the black arrow that I had put in here showed a relatively swift decline in the number of new cases in those countries where the growth was higher than 5%. And then since the middle of April, the trend has still been our friend in the blue line, but it's just been progressing slower. So the main conclusion when you look at this is that we're still moving in the right direction, that there are fewer and fewer countries that have a 5% growth rate. In other words, there are fewer and fewer countries where this is accelerating out of control, which of course globally in particular is very good news. Similarly, the line, which is VIX, that also came down very quickly in beginning of April, and then has also been moving sideways for the last 1.5 months or so. That makes sense that the VIX and markets don't adjust as quickly and progress as quickly given the risks and the uncertainties about what's going on in markets because of fundamentals being so uncertain. But the bottom line in this chart here is, as I've written in the title, the virus peaked 2 months ago. Well, now it's more like 2.5, 3 months ago, but 2 or 3 months ago, depending on which country you look at and exactly which part of the world you look at. But the market stress is going away, but the speed of progress is slowing. So the first conclusion is still that globally it looks like things are more under control. And for every day that we get out of bed, it does look like things are gradually getting better relative to where we were just, again, even a month and, of course, 2 or 3 months ago. The second point, of course, is financial markets. This, of course, is more important and generally, of course, more interesting, generally speaking, than spending all our time looking at the health situation. The health situation, of course, plays a critical role because that's a very important domino break for figuring out what the shape of the recovery will be. But if the first conclusion here is that it looks like we have the health situation, at least globally, more controlled. The US we're watching, but again, there's some important nuances, whether this is only the new cases, also the death rate, or is it also the hospitalization? And our conclusion still is that it still looks, in our view, as not a second wave, but rather as a logical consequence of reopening, that you will see some spikes, and then we will see some tango, one step forward, one step back, but ultimately we will get out of this. Let's now check out financial markets and what's been happening. And the broad question that, of course, that we always should ask ourselves is, well, how far along have we come in normalizing things in financial markets? And this chart here shows you the blue line is the Office of Financial Research Financial Stress Index. The red line is the Bloomberg United States Financial Conditions Index. So these two lines measures financial conditions in the US. So specifically, these two lines are throwing into the kitchen sink daily indicators for the stock market, for IG credit spreads, for CMBS spreads, for credit card spreads, for auto loan spreads, for mortgage rates. Everything goes into the crunch machine, and you end up doing principal components and asking the question, what is the variation that these series have in common? And these two lines here, there's some nuances in how this is calculated, but these two lines shows you what is the level of distress in the financial market at the moment. And as you can see, we've come a long way over the last 3 months since the peak here in March. Interestingly, the peak in March was nowhere near the peak that we saw in 2009. And we're not quite back, as you can see over here to the right, to where we were in February. But the most important point in this chart here is, again, is that financial markets are definitely moving in the right direction. And of course, this becomes very important for any debate about what will the shape of the recovery be. Given this is moving down very nicely here, that of course means that this increases the likelihood that we will have a faster recovery, and that therefore increases the likelihood that we'll have our swoosh-shaped or even a V-shaped recovery. The problem is there's some other reasons why, of course, that could not be the case, but this alone at least has shown a significant improvement. This is the same you see in some of the subcomponents of the Financial Conditions Index. So this one is the blue line is financial commercial paper minus OAS. The red line is non-financial commercial paper minus OAS. And look at both these lines also. Again, both of them, of course, peaked here in March. The red line, interestingly, had more trouble. Non-financials had a lot of trouble, of course, when the economy went into a shutdown and there was no cash flow. There was no earnings coming in the door in the corporate sector, which basically meant that we didn't see the cash flow and the earnings and the EBITDA that we would normally have seen. That meant that there was a lot of distress in the non-financial sector in the red line. This was very different from 2009, where all the distress over here, of course, was in the blue line and in the banking sector. So in that sense, the nature of this crisis, of course, was quite different in that this time around, the shock was hitting the corporate sector and it was not really hitting the financial sector. The main conclusion in this chart is the same. We are basically back to levels where we were in February. Commercial paper markets, both for financial and non-financial markets, are absolutely functioning. And this, of course, is in no small part, thank you very much to the Federal Reserve being so incredibly helpful with both the commercial paper funding facility and providing support to credit markets. This is also what you see in the next page. This is the yield of investment grade credit. This is the blue line. As you can see here, that's basically back to where it was in February. You can spend a little bit of time thinking about whether February was too low compared to the historical levels. But the main conclusion is that IG markets are totally open, back to where they were before. High yield is not quite back to where it was before, but it has definitely come down a lot. And of course, it looks a lot better. One area that, of course, gets a lot of attention is that, well, wait a minute, weren't there a lot of issues in high yield and in loans and in CLOs and private debt that we should have thought about and worried about? Because those things were very important even before the virus. So what I've tried to look at in this table here is to say absolutely those risks in credit markets are still here. And what are those vulnerabilities? And those vulnerabilities, of course, are high yield, levered loans, and private debt. As you can see, the size of those markets, levered loan markets, are by far the most important one. But this is telling you still that at the bottom of the credit spectrum, there are still a number of things that we need to worry about, because these things were worried before the crisis, meaning before the March hit of the virus. And those things have just gotten worse now that we suddenly have magnified leverage even further, thanks again to the Fed initiatives. And what are those vulnerabilities? I'm not going to talk about all the details, but it's valuations, borrower's leverage, embedded and financial leverage, liquidity and maturity, FX mismatches, concentration, interconnectedness, complexity, and opacity. So there are a lot of things here that we spend a lot of time thinking about. How vulnerable are these three markets over here? And of course, those issues have not gone away despite the chart that I just showed you. One final point, of course, on markets is then to think about, okay, that's all good and interesting, but I mean, aren't stocks incredibly overvalued given how far we have come? Aren't credit markets very overvalued given how far we have come? And that is true, and it does look like that when you look at the 12 forward PE for the S&P 500. As you can see, this chart here shows you that the 12-month forward for the S&P 500 in round numbers is roughly around 23. And this, as you can see, going back in time, we've never had such an overvalued stock market as we have today. So why do we not worry about this? Well, the main answer to this is that Jay Powell doesn't seem to worry about this either. His goal seems very clearly to be to support the corporate sector and to support corporate credit markets and carry the economy across the river and make sure that credit markets are functioning, that the commercial paper markets are open, that credit markets are open also for the household sector, and credit markets, of course, also open for IG, for fallen angels, and significant parts of high yield. So in that sense, yes, I do appreciate, and it is very important to keep in mind that valuations are very, very high. But when you think about this in very broad terms, value versus growth, value really hasn't mattered for the last decade. So in that sense, why should value begin to matter now? I appreciate, again, that this does look high, but remember that the issue that we're looking at the moment is that the economic data is gradually, slowly getting better. We are getting more clarity about what the future will look like in terms of earnings for the corporate sector across the board. And all that argues still for an increase in the stock market, which is we have the S&P 500 ending the year at 3250. In other words, not as significant as increase as you've seen here, meaning as quickly, but still an increase going forward, simply because of more clarity about where the economy is, more clarity about the reopening, and therefore, more broadly speaking, also the Federal Reserve providing still more support, in particular as long as the economy continues to be as relatively slow moving forward as it is at the moment. Let me end the third and final part of the presentation on talking about why we expect a swoosh-shaped economic recovery. So far I have told you two things. We think the virus is generally under control. That's, of course, very bullish for the economic outlook. We think that markets are also better than they've been in a long, long time. That's, of course, also very helpful for the economic outlook. Why do we then still expect the economic outlook to be slow? Why don't we expect a V-shaped recovery? Well, one very important reason for this is the following few charts. This chart here shows you, if you look at the text below the title, this is jobless claims in the last 12 weeks as a share of the labor force. So this is telling you essentially how many people lost their jobs in the states to the left: Georgia, Kentucky, Hawaii, Alaska, Louisiana, Oklahoma, and interestingly enough, a swing state, Michigan, Washington, Nevada, Rhode Island, another swing state, Pennsylvania. You can see that the unemployment rate, the number of people who lost their jobs in those states, was in round numbers between 35 and 50%. Why did so many people lose their jobs? Because these economies, or these states in these local economies, essentially went in shut down and therefore had to lay off many more workers. Relative to the states here to the right, Wyoming, Colorado, Nebraska, South Dakota, Utah, you've seen much, much smaller increases in the unemployment rate. And why is this important? This is extremely important because this is highly, highly unusual when you think about this from an economic perspective. Normally, when there's a recession, the unemployment rate goes up everywhere in sync. The unemployment rate goes up 5% in some states and 5% in other states, and then it goes down in sync again in all states with the same number. But because some states had a shutdown over here and other states did not have a shutdown over here, this has created a very, very idiosyncratic and asymmetric situation. Put differently, the max difference in state level unemployment rates today is almost 40%. This is 50, this is 10. This is wild relative to 2009. The max difference between state level unemployment rates at the peak in 2009 was only 10 percentage points. So if you are operating a company in a state to the left, if you are giving loans, if you are financial operating in the states to the left, of course you will have bigger loan losses. You have more problems with people not paying their auto loans, their credit cards. You have more problems with corporates. You will have more problems with the labor market and consumer spending more generally relative to states to the right. And this specific chart here is creating a lot of problems for quant funds. Remember, quant funds normally rank companies according to, say, revenue growth and R&D and leverage. So you rank companies to how much leverage do they have. I like companies with low leverage. I don't like companies with high leverage. I like companies with high revenue growth. I don't like companies with low revenue growth. And I like companies with high R&D, and I don't like companies with low R&D. And that gives me different screens that makes me rank what companies are going to perform well in the future. The problem is that the quant funds simply were not prepared for the whole new factor that the virus has created, namely that some states have seen unemployment rates go up dramatically and other states have just not seen the unemployment rate go up very much. And this basically, in other words, is a new fact that has entered the equation. In other words, in statistical terms, when you do principal components or regression analysis, you will suddenly have a new factor that suddenly has become important, that never has been important before. So how do I run a statistical analysis when suddenly a new factor, here the unemployment rate, has become more important? So the first observation is quant funds and quant strategies have been in serious trouble because we suddenly have a whole new factor, a whole new variable that has entered the equation that is becoming important because, again, you will have bigger losses, you will have bigger implications for consumers and a slower recovery in the states to the left relative to those to the right. So this is a cyclical argument for why we're going to have a weaker recovery. There is also a structural argument, which is the one that you see here. And that is what you also spoke about on the previous panel, namely that there are some behavioral changes that are going to slow growth. And what are those behavioral changes? We categorize those changes into changes for the household sector, there's changes for the corporate sector, and changes for the government sector. The government sector basically means what are regulations and rules and requirements that are going to come in the future that are going to have an impact. So let's just look at the household sector just to run these points to make sure that we understand what behavioral changes are and why we expect this to weigh on the economic recovery over the coming quarters. Well, first of all, we have an increase in precautionary savings for households, similar to what we saw after the Great Depression in the 1930s. More space between seats at restaurants, cinemas, sports events, concerts, conferences, trains, buses, and airplanes. Of course, this is going to create less GDP. This is going to create less consumer spending. And of course, for businesses, this is of course going to create less revenue. Fewer people traveling on vacation, going out until we have a vaccine, all contributing to lower consumer spending. Older generations staying at home until a vaccine is released, less willingness to put parents in retirement homes, limits on the number of people in supermarkets at the same time, more online shopping, more online doctor visits, fewer people going to fitness center doing group sports, more people driving their own cars to avoid public transportation, and health insurance premiums going up. I appreciate that this is a bit of a dog's breakfast in different ways and different dimensions, but this is why this has become a stock picker's environment. You now need to do your homework and figure out of the businesses that I'm looking at, how vulnerable are they to these different points, and for that matter, all the points I also have down here. And the answer is that those stock picking exercises have already played out in public and private markets, of course. Those that are the winners and those that have been suffering from COVID-19, of course, have already seen consequences as a result of these behavioral changes. And one very important part of this debate, of course, is the behavioral change on consumers. If you look at this chart here, this shows you the share of total US consumer expenditures by age. It shows you that people that are more than 65 years old, they account for 20% of US total consumption. People that are more than 55 years old, they account for 40% of total US consumption. Note that this has gone up for both the generations of just 55 and 65 years old because the number of people in each cohort has gone up because there are more baby boomers. So of course, if older generations are going to stay home until they have a vaccine, we will therefore also, of course, have less consumer spending. So therefore, this is a very important behavioral impact that older generations are probably going to stay more cautious on buying cars and washers and dryers and furniture, also on going out to restaurants, on cruises, on airplanes. And that, of course, means that given in particular, if you take the bigger category, that a lot of people will be holding back consumer spending, and that will, of course, have serious consequences for the shape of the recovery. Now, you could then say, okay, so the shape of recovery will be slow. So what? This is probably what we're looking at. Well, the problem, of course, is that not only that, the unemployment rate going up is also going to create some problems whether households actually can manage their balance sheets for the period while we are in a situation where the unemployment rate is so high. So this chart here, the blue line is the unemployment rate, the red line is loan delinquency rates for the banking sector. This is both consumer loan delinquency rates and corporate loan delinquency rates for the banking sector. And as you can see here, I appreciate the correlation is not always great between these two lines, but it is pretty important now to think about whether the unemployment rate is going to stay at these extremely elevated levels, and the Congressional Budget Office expects that the unemployment rate by the end of the year will still be more than 10%. Well, that tells you you should begin to risk and worry about whether this might be turning in from a liquidity crisis to a solvency crisis. And you also see the same thing on the next page. Again, the blue line now is the unemployment rate. The red line is the total new Chapter 11 bankruptcy filings. Again, the unemployment rate has gone up a lot. And I'm not saying bankruptcy filings will jump up to these very high levels here, but I am saying that we do need some more fiscal support to prevent this from turning from a liquidity crisis to a solvency crisis, because if you have an unemployment rate that stays so elevated for so long, it will be creating a lot of problems. And before I get to the final page of the investment implications, let me just then mention one very quick and brief point that is a consequence of everything that's been going on. One thing that is becoming critical when you give all this support from the Federal Reserve to the economy is that you get suddenly a rising share of companies that have debt servicing costs that are higher than profits. And this chart here is, I went back and looked at the 8,000 companies that are listed on the exchanges in the US. So think of this as the Wilshire 5,000 and asking the question, which is what I've written here. Firm level data is used to calculate the share of listed firms that are more than 10 years old with an interest coverage ratio of less than 1 for 3 years in a row. In other words, a bigger and bigger share of companies in the US economy are no longer able to service their debt servicing costs. They simply do not make enough money. And why is that important? Well, that's of course really important because that means that we are at risk of turning into the risk of the situation that we had in Japan in the 1990s, where a rising share of the economy, in this case at the moment roughly 20%, are now suffering from not being able to make enough money, making enough revenue, but are being kept alive artificially by low interest rates and the Fed doing so much support to credit markets. And that of course means that a lot of resources, workers, capital is tied up in companies that are just simply not very productive and simply not very helpful in terms of boosting GDP growth. So the ultimate consequence is that if this continues to go up, which I have every reason to believe, then it will have the negative consequence that the growth rate over the coming quarters and years will continue to be dragged down by more and more companies simply not being profitable and simply not being able to generate enough revenue and generate enough growth. So let me end in the last 2 minutes I have left here with investment implications. This chart here summarizes our views on markets at the moment. The Fed obviously is on hold. That's not a surprise. They're not about to raise rates. They will not do negative interest rates. There are 3 reasons why we don't expect negative interest rates. First of all, it hasn't worked in Japan and Europe. Second of all, if you do deep negative interest rates, say minus 10%, you run the risk that you will have a run on the banking sector where people will say, well, why should I have money in my bank account if I have to pay 10% every year? I'll just have it in my mattress. That could create a bank run, which of course will have a lot of risks associated with it. And the third and final reason why we don't expect negative interest rates is because this is just not the right tool for this crisis. This crisis was a hit to the non-financial corporate sector. So therefore you had to see something that hit credit markets and helping credit markets rather than helping the Fed funds rate going negative. So the main conclusion is we think the Fed is on hold for now. We think 10-year rates will slowly move higher from here. We think credit spreads will slowly move narrower because the Fed will continue to provide a boost. We think that with flatter epi curve and recession curve also will provide support to equity. We're quite bullish both on credit and equity simply because the Fed support continues for a very long time still. We think the dollar will go down because the interest rate differential between the US and bunds has now narrowed. So that means that on an unhedged currency basis, you should expect to see the dollar move lower. On a currency hedge basis, it still looks a little bit better, but the main conclusion still in our view is the dollar moving lower. Commodity prices, of course, have moved up, and we expect that continue as the economy reopens, and we expect, again, as more cars are on the roads and we see more activity in the economy. Remember, 40% of oil demand goes to trucks and cars, So the more that we open up and trucks and cars go back on the streets and the roads, of course, then we will also expect to see more demand for oil. Emerging markets, I didn't talk too much about that, but that's of course also all about the health crisis and whether they will get a loan from the IMF and to what extent there are any issues in terms of getting support from, broadly speaking, the IMF and of course from US and Europe getting back on track. So the bottom line is that, as I said from the beginning, we expect a relatively slow recovery. We expect that to be driven very importantly by the factors that I mentioned, both with the unemployment rate and behavioral changes. But the three things that we're watching continues to be the question about the virus, the question about markets, and then the shape of the recovery. And as long as the virus looks okay, I know we could debate that for a long time, markets look okay, we expect the recovery to still be relatively slow, but steady over the coming quarters. So with that, I think I'm just spot on 125 here. So let me turn it back to you here, Mike, and stop sharing my screen.
Hey, Torsten.
Yep.
Would you like to answer some questions? I'm the next presentation, so I can give you some of my time, and I'm happy to do so. It was an excellent presentation, but I understand that if you're busy and you can't answer some of the questions. But
we could maybe take one or two questions very quickly. I do have to do something else here at 1:45, but why don't we take a few questions if you will allow me to take a little bit of your time? That's fine.
Absolutely. So the questions are coming in right now. Torsten, what's your outlook on international versus U.S. stocks versus EM?
Yeah, so this is very important. As I was trying to say, there are some important, most of the focus here, because I know most of you concentrate on the U.S., so most of the focus here was on U.S. markets, what's been going on with the S&P 500, of course, and also with credit markets. But a very important ingredient when I think about the relative performance going forward of U.S. markets relative to markets abroad has to do with this issue of these two things that I mentioned, namely, most importantly, is the virus under control? And the second thing is what have markets done and how far along have we come in the adjustment, and will that continue to be helpful? And associated with that, what has the fiscal response been in different parts of the world? So let me just give the short answer to that question, therefore, is that given the virus now looks more problematic in the US relative to, say, Europe and emerging markets, that does argue for Europe and emerging markets generally doing better on that factor alone. The problem is when you look at the second factor of what the fiscal response has been, the US government and the aggressiveness of the fiscal response in the US has been much, much stronger relative to what we, at least up to this point, have seen in Europe and in emerging markets. So the reason why the US economy is still holding up relatively well, and the reason why still non-farm payrolls was so relatively strong, and why the income data and the consumer data and the retail sales data here more recently has been so strong, has to do with the fact that the US government was very quick at sending out $1,200 checks to households. It was very quick at providing support through PPP to small businesses. We could debate whether this was done the right way or whether there were some problems with that, but at least of these, the magnitude of these initiatives that the US has done has been so much more aggressive, so that at this point, given my expectation is that more is coming still in the US, we've been debating this, as you saw Mnuchin yesterday and today has also been talking about this, that $1 trillion stimulus more is coming. Then there's debate about whether that's infrastructure or whether that's incentivizing workers not to sit at home, but incentivizing workers to go and take a job. All that, of course, will also argue for the US still being a relatively stronger recovery than what you have abroad. So the main conclusion is, I still think that, first of all, the aggressiveness of the Federal Reserve has been much more significant than other central banks. That argues for US markets doing better. Secondly, also the fiscal support, meaning what the governments have done in terms of supporting households, supporting consumers, is also bigger in the US and expected to continue to be bigger in the US. That also argues for outperformance in the US. The only third factor that argues for underperformance in the US is the virus situation. But given that I said that the US virus situation is expected to be under control, I would say that the short answer to that question is that I would still expect US markets to outperform European and emerging markets on the equity side and on the credit side.
So Torsten, we have another question coming in from Bifei Zhang. What caused the huge different employment rates across different states?
So what caused that was that some states had a shutdown. So those I had there to the right, Utah, South Dakota, they never had a lockdown. They never had a shutdown. So when you had a shutdown in significant parts of those states that I had there to the left, that of course meant that a lot of people were furloughed, a lot of people were fired. So that is the number one reason in that chart why the unemployment rate is so much higher in some states relative to others. In other words, some governors, and as you know, this is all at the regional level. Some governors simply decided to much more aggressively shut the economy down, and that resulted in a much more significant increase in the unemployment rate in those states to the left relative to those to the right. Wyoming, Colorado, again, South Dakota, Utah, where you basically never saw a shutdown. So that's the reason why the unemployment rates are so different across the country at the moment.
Do we have time for one last question before we?
Yeah, we can take one more.
All right. Japan accelerated money supply to perpetuate asset market gains in 1990. By the way, this comes from Brett. That worked for a while until it didn't. What factors would you consider for the U.S. markets to gain a sense of when valuation starts to matter again?
Yeah, so that's a good point. So this is a very, as you all know here, a very important debate in the equity market. Well, when does growth matter and when does value matter? And as you know, this is almost a philosophical question of why is it that the market hasn't cared for 10 years in a row about value? Why has it all been tech? Why has it all been growth? And why have valuations not really been an issue? At the moment, I would argue now it's about also growth. We're standing at the bottom of the economic canyon, if you will, with the data. So that's why I still expect that the growth story will continue to matter. So that's why tech and healthcare and parts of retail that have benefited the most is still the parts of the S&P 500 and also private credit and equity markets that I think will do the best. So the short answer to that question is that I have a hard time figuring out over a very long period the reasons why value has been such an underappreciated issue compared to how significant value normally is in our discussions. But I still think that in a Japanese case, they never succeeded in creating that boost to asset prices that the Federal Reserve has now been so extremely successful at doing. And given the Fed is, and I do not hear Jay Powell worry about anything with valuations. On the contrary, I hear him constantly say, I will continue to support credit markets as long as it's needed. And in my view, that means I'll continue to support credit markets as long as the unemployment rate is very high. And given the CBO and the Fed has the unemployment rate still very high, at least with the CBO saying the unemployment rate being 10% by the end of this year, I still think that risky asset stocks will continue to do well. IG, fallen angels, and a significant part of high yield will also continue to do well.
All right, one last question. Given the failure of the established economic theory at work, neoliberalism, do you believe the Fed is backstopping bad behavior?
This is almost an ideological question, but I do believe in principle, very generally speaking, that when the central bank begins to buy investment grade credit, when the central bank begins to interfere with saying, we think credit spreads should be narrower, we're going to now deploy enormous amounts of money to buying ETFs and individual names in credit. This is essentially interfering with the process of creative destruction. And when you begin to interfere with the process of creative destruction, it creates a lot of problems. So think about the normal situation in the US. In a normal situation, 1,600 companies every day go bankrupt in the US economy. And if you begin to say, we don't think 1,600 companies could go bankrupt, let's give them some government support. Let's try to provide this support, both IG and fallen angels, and make sure that these companies don't go under. If that's the case, then of course you will certainly have a situation where the risk is that you have kept companies alive. That's why I had this chart about zombies, where the risk is that you get into some Japanese situation in the 1990s, where you simply have the companies that they're being kept alive that are not productive. And this is ultimately, again, if the process of creative destruction is not allowed to play out, and therefore neoliberalism, to the good question here, is interfered with in a very interventionist way, it certainly creates a lot of philosophical and fundamental questions about whether the U.S. economy can continue to be as dynamic if you keep companies alive that otherwise would have gone under. I'm not saying that the Fed should not have intervened in March. They did that, and they deserve nothing but praise for making sure that market functioning was working. But a side effect of the aggressiveness of the things that they're doing is that it's keeping companies alive, and we need to find a way as investors to think about how we want to deal with this and how we can avoid investing in those companies that are most vulnerable. This is why, again, it's becoming a stock environment. Passive investing, that discussion is nowhere to be seen at the moment, because the passive investing has been proven here in this case that the stock pickers environment was exactly, you had to pick those sectors that were benefiting, if you will, from the virus, and try to avoid those sectors that were hurt most by the virus. And that's why I think that this again, idea of intervening in the process of creative destruction is a very, very important ingredient in thinking about everything that the Fed has been doing. And quite frankly, even the PPP program has many of the same features that you can begin to think about what the consequences are of whether companies are being kept alive or not.
All right, Torsten, thank you very much. Thank you for taking extra time today to answer some of the questions. With your permission, I'll share your presentation with the people that requested it. Is that okay to do so?
That should be okay.
All right. Thank you very much for coming on. I've been trying to get you on for a long time. We hope you come back soon. It was an excellent, very enlightening presentation today. Thank you.
Mike. Thanks so much for having me.
All right.
Talk soon. Bye-bye now.